your guides to a really great financial future. Tom and Don are talking real money.
It's Double Duty Podcast time again. Hello, everyone. Welcome to the Talking Real Money Dualcast. It's the podcast, it's the vidcast. It's a little bit of a cast for everyone with this cast, me, Don McDonald, sitting here in the Virginia studio again. I feel like John Oliver against this blank void. Or is it this way? Anyway.
Now, wait, the blank void is the background or your never?
Yeah, no. Well, since COVID, he's been doing it from like his basement with a white wall, and he calls it his blank void. I like John Oliver. My wife does not. So we're just.
I find him funny, but I don't watch him. But I find him funny.
I got to tell you, I find him funnier when he has an audience.
Because you got something to play off of.
Yeah. Yeah,
I now have a chair in my studio at home. I need to have an audience. I need to have
one person.
Yeah, they can applaud, they can laugh, they can
No. You see, audiences need other audience members.
Okay, so we need fake.
We need a live studio.
Track.
No, what we actually need to do is figure out a way to do this in front of a streaming audience where they're little
Like the Hollywood Squares thing where you see all those little faces pop up, that kind of thing.
Okay, this is a bad idea. And it really has
nothing to do with money.
It has nothing to do with money. Did I introduce Tom?
No, you didn't, as usual. Hi, I'm Tom Cock. Thanks for joining us.
I usually introduce you.
That's true. You do. I'm giving you a bad time because you're talking about the blank void, and I was concerned you might be talking about your.
Well, that's occurring. As you know, I'm just like you, getting older.
I understand. I took more hits to the head, though, than you did, so I'm worried.
Oh, yeah. No, you're going to go. This is going for you faster than me.
Pretty quick.
Yeah, I did not play sports.
Smart guy.
Yeah, I played like Little League for like 3 days, and they kept putting me out in double right field.
I remember that.
Actually, I remember that. Double right field.
You be the guy right behind that guy.
You go out there in case somebody hits a 400-foot home run in Little League.
And watch out for the butterflies because they might fly by.
Anyway.
Sorry.
We're going to talk about the exact opposite of being young and playing sports, retirements. The process
Fun.
The process of getting old is universal. We're all doing it every day, and there will come a point when this is more of a blank void for Tom. And he's not going to be able to do this anymore because you don't want to listen to a guy going, that's all he's going to say.
Actually, that might be better than the bad jokes I have normally. So you may be wrong there, but okay.
Good point. Let's talk about how you fund retirement because I think there's a lot of confusion around this. I was just talking with a friend today who is like thinking about converting to a Roth and said, well, all my friends say to convert to a Roth and they don't have the money to pay the taxes to convert to the Roth. And I don't know that anybody really gets what all this is. So let's talk about all of the various accounts. Now, this is important to understand. We are talking about accounts, not investments within the accounts. An IRA is not an investment. A Roth is not an investment. A 401k is not an investment. A 403b, et cetera, et cetera, et cetera. Plus, there are these really cool self-employment options or small business options that we want to make you aware of. So, Tom, the basics. We start at the highest level, really, is the company sponsored traditional plans, the 401s, 403s, 457s. What are those?
Well, we'll go through those. But here's the thing: that only covers, I think it's less than half of America can get into one of those. So there's a lot of people that can't get into a 401k, which is an ERISA plan, employer sponsored plan, right? This is put together by your employer. You can put money in. They may or may not have a match. May or may not always. Sometimes
it's not required.
Not required. Some are very generous, some less generous. I mean, that's something to look at in terms of a benefit if you're thinking of going to work for a company. 403b is a similar type of plan, except that is with a not-for-profit organization, government at all. 457, also deferred compensation, similar enough, right? This is money, pre-tax money you're putting away.
Do you get a little ding every time you give a good answer?
I'm trying to stop this.
I thought maybe it was like okay, Tom got that one right. Ding.
Yeah. Well, as you know, there wouldn't be that many dings
Right.
during the day.
That's what I figured. He got one right.
I'll take it. So those are kind of the employers. What am I missing on the employer sponsored side?
You pretty much have it. I mean, it's 401.
There's 401A, which I always get confused.
Well, but 401, yeah, okay. Then we get in, but those are for highly compensated people, and let's not get into all that. Basic ones: 401k, 403b, 457.
Yep.
All of those are company sponsored or employer sponsored plans that in which you can choose to participate or choose not to participate. They can or cannot match, and then there are two kinds of those plans.
You mean either pre-tax or Roth?
Right.
And that depends. The plan has to offer those options. They don't all offer a Roth option. Not all of them.
But what's the difference?
Well, one comes out of your check before any taxes paid, gets invested, grows, and then when you take it out, you pay regular income tax on it. The other goes in after you've paid taxes. That's the Roth part. And then it grows. And when you take it out, no tax. So for a young person in a low tax bracket, I think it makes a ton of sense to put it in as a Roth, correct?
Mm-hmm.
Then maybe when you get a little older and your tax rate is a little bit higher, you could do some in pre-tax, some in post-tax, depending on your current tax rate and what you expect it to be in retirement. That's always the kind of the guess. But I like to do both because I like the idea that you have several pots, if you will, to pull money from when you retire.
Now, for those who don't have a 401k, a 403b, or a 457 plan at work, then there are individual retirement account options. And that's what IRA stands for, is individual retirement account.
And this is, a lot of people throw up their hands when they work at a job where they don't have a plan. Or they go to work and, well, you haven't been here long enough, or you don't work enough hours, or you're not qualified to be in the plan. And they say, well, I don't have a retirement plan. Baloney. There really is a retirement plan for anyone who has income. It's called, as you just pointed out, the individual retirement account, IRA, or the Roth individual retirement account. And it is yours, by the way. It's always yours. And when you pass away, you can leave it to others. I got that right again.
Another one. Good job.
So I don't know. I have no idea how to turn all that off. I probably have to shut you down to do it. But those are places anytime you have income. So as a young person, when you have income, you could do a individual retirement account or a Roth. And by the way, if you're married and your spouse has income, you can again do an individual retirement account. So there's really no excuse. Talking to some of you in the audience who tell me, well, I don't have a plan at work, so I can't do anything. Yeah, you pretty much can.
Well, but what about the income limits for funding Roth IRAs and traditional IRAs and getting the tax deduction or the tax free?
This is, you get into a little more of the detail, right? I think it's $6,000 maximum for folks who are putting money into an individual retirement account or a Roth retirement account up to age 50. Then you can add another $1,000 after age 50. So now it's
to bring you to $7,000.
Right. Correct. You could get trickier here if your income's above the $208,000 as a couple and you can't fund a Roth IRA. You could do a backdoor Roth where the money goes into an IRA and then immediately goes over to a Roth. Again, getting into the weeds here a little bit, but there are always ways to save. And I try to tell people, as soon as you have any income or your child has any income or your grandchild, start a retirement account. Doesn't mean all the money has to go there, but something. So you see kind of the benefit of saving, you see the benefit of growth, and you're building for a long-term future. No, it won't buy you a house or a car, but it should buy you retirement way down the road.
And then for the self-employed or for the very small businesses that just have a few employees, there are some other options, some of which have been around for a long time, one of which is relatively new.
I don't know the relative. Is that the solo
401k?
Yeah. Okay. So, which is, again, I don't know enough to know about the differences between that, a SEP IRA, and a simple IRA. But those come down to income.
Well,
I mean, not
yeah,
income
here's
limits
the
or
difference. Here's
limits
the
of
difference.
contributions.
A SEP IRA is more of it's geared more toward a sole prop. It's a simplified employee pension IRA. And in a SEP IRA, you can put away about 20% of your profit.
25,
Is it
20, not of your
25
profit, of your gross income.
of your business
25%
profit
of your business income.
minus
Top
a
line.
deduction of part of your self-employment tax
Yeah, you got to
or
take but still
$58,000.
a lot of money you could put away, which is more. We didn't give the limits for the 401k, but that's only 19.5 unless you're old like I am. You could put away $26,000 a year there.
And then a simple IRA is actually simpler than a SEP. There's a lot less paperwork and record keeping. It's more like an IRA for small businesses and self-employed. And you have to, in addition, you can contribute to your own as the proprietor, but you also have to contribute to your employees' plans at a similar rate. But the contribution can be relatively large, about 13.5. Yeah, for 2021, it's 13.5. But then there's the solo 401, which is really
Hans
nice.
has got his own plan.
He's
Right.
got his
I love
own
it.
plan. And the really nice thing about that is that the contribution limit is the same as for an employee sponsored 401, the 19.5. And you can also give an employer contribution, and it's for small companies, and it keeps the costs low because it's a very simple plan to set up.
You don't have to do as much reporting as you would in a 401k.
Exactly.
Plan,
It doesn't
per se.
have the ponderous reporting that a full-fledged 401k plan has.
So you can put in your contribution, and then your company can make a match of some kind. Is what
Right.
you're saying. Very good.
So it's very, very similar. Plus, there's a catch-up contribution of $6,500, just like the regular one, if you're over 50 years old. So those are really your big options. And then there's one other that people don't think about. Let's say
the Don McDonald Pension Fund. We all throw a couple bucks at that.
You've maxed out. Well, yeah, sure. You've maxed out all your other options. You've got your 401k funded or your solo 401k. You funded your Roth IRA. You still have some money left. You want to save it for retirement. You want some sort of a tax benefit to go along with that. You don't want to pay a lot in taxes. Nobody does. You should just go out and buy an equity-oriented, exchange-traded fund. Why?
Just in a regular brokerage account. Is what you're saying. You're saving something.
Why?
Why should you buy that?
What's the tax advantage? See, this is something people don't think about. There is a tax advantage to a growth-oriented ETF that we don't think about.
Well, unless you're selling it and unless you're selling that fund, trading it, then there's really very little tax you're going to pay on that as it continues to grow.
Because in an ETF, capital gains even are not realized and therefore not passed along to shareholders.
Correct.
So you can buy an ETF like VT, for example, the Vanguard Total World Stock Index ETF. You could buy that today and hold it for the next 30 years and not pay a cent in taxes on the growth in the value of the fund. Yes, you will pay taxes on distributed dividends, but those tend to be
small.
It's in the 1.5-2% range.
The only time you're going to pay on that in a brokerage account is you're going to pay capital gains when you start selling some of those shares and taking the money and using it for something else.
But let me tell you an advantage that most people don't realize either. When you take money out of your regular IRA or 401k, you pay taxes at your regular income tax bracket. And today, and for most of the recent past, the rate for income is and has been much higher than the rate for capital gains. When you take money out of that deferred ETF, you're going to pay taxes, but it will likely be at the lower capital gains rate than at that higher income rate.
Yeah, no, that's a very good point. So just to go back, I mean, again, I think anyone who has a job of any kind, teenager, son, daughter, grandkid, whatever, you should help get them started. And here's an easy place to do it because I think they now have qualified accounts too, right? Acorns, which we haven't talked about in a long time, but it's automated. you don't have to do anything. The money comes out of the bank account, goes into the Acorn, gets invested in a global portfolio at a pretty low cost, and it's a set it and forget it situation. For most people, that, by the way, is the best way to save for the future, rather than requiring them to write a check, requiring them to move money, because it just feels difficult to do that. When it's a disciplined approach, it works. That's what my take on all that.
All right. Now we're going to take a comment
Uh-oh.
that came in from talkingrealmoney.com and
I
a
can
question.
see from your face, it's scaring me. Yeah, okay.
That's not too scary.
All right, okay.
On Saturday's show,
Well, I can't take much blame because I was only on for about 40 seconds, so I'm
or
okay.
Monday's podcast,
Yeah.
I mentioned a review we got from a young person
Yes.
who went by the moniker of Marks something or other, who said, we are just a show for old people.
Yeah.
And that we're not hip enough to get crypto.
Or
Maybe
to buy
not.
it, for that matter.
I wouldn't.
Charles
Okay.
Barkley said his advisors won't let him do it, so that's good enough for me, by the way. So,
What's with Rick Edelman? Anyway.
Rick, please.
So anyway, someone responded to that,
yes.
and I wanted to read the response.
They said, yes,
I haven't read it yet.
You are old.
My thoughts on young people is the subject, the topic.
Okay. So this is
Don.
the review. Yeah. Okay.
Hi, Don and Tom.
Yeah.
I heard your segment about only appealing to rich old people who want to invest $200,000 and felt obliged to reach out.
And boy, do we appreciate it.
I am 27 years old.
Oh.
There you go.
Kinda
See,
young,
there
yeah.
you go. And have listened to your show for a few months now. I really do enjoy it and have found it quite useful. I also listen to many other podcasts to stay well-rounded. As a younger person, I would love to know more about what percent of my income I should be saving for retirement, in what assets, and how should my strategy change as I get older. For example, is my Roth IRA or my Roth 401k better if my Roth 401k has good investment options? Where does my HSA fit into this picture? I do like your investing advice, but it does seem geared toward people closer to retirement. How should a 27-year-old's investment strategy differ from more typical advice you give for those rich old people? Anyway, the show is great, and don't listen to those young haters who are still living in their mom's basement.
I think I did say something about that. So that may have elicited some of the negative response. I do believe.
Isn't that Joe Saul Seahigh from Stacking Benjamins too? Joe?
I think I said something. I think I did too. I feel bad.
Aren't you still living in your mom's basement?
And not paying the cable TV bill? Yeah, got
cable
it. Okay.
TV bill.
Sorry.
Yeah. But then, she makes a great point. How do you invest when you're in fact, turns out to be a comment and a question.
This is pretty easy. Okay, number one, if you have an employer plan, you save at least up to the match.
Mm-hmm. Which is what makes your Roth 401k better than your Roth IRA, because there's free money.
You can put money in your Roth 401k. The match is always going to be in pre-tax regular 401k.
Right.
Them's the rules. Number two, in terms of asset allocation, for a 27-year-old, you should be very aggressive if you can take the ups and downs of the market. You should be 90% in stocks.
100% in stocks.
Yeah, I mean, if you could take the volatility, remember, volatility is good when you're 27 because if the market sells off, you're buying more shares at a lower price. It's a good deal, but it's still emotionally can be difficult. Number three, the asset allocation part. Here's the way I would look at it. In the Roth port, put the assets that have appreciated more quickly. Small value, international small, if you have that. Value funds of any kind could be in the Roth 401k. Then, because he asked the point, or she made the point, well, okay, what if I have a Roth IRA? Then again, those would be the more aggressive parts of the portfolio, and they may be things you don't have in your 401k. We look at a lot of 401k plans that have very little international, very little really small value. They don't have emerging markets. They might not have REITs. Asset classes, groups of stocks you can't get in your retirement plan at work. You can buy those in your Roth IRA outside of work.
And she also asked, how does her HSA fit into this picture, her health savings account?
Yeah. So, I mean, with the HSA, I always advise, because the HSA is designed to be there for sort of unexpected medical expenses. Mm-hmm. So I still would prefer to keep half of it in money market, short-term bonds, something like that. And then maybe the other half is invested. And they usually give you a list of things. Again, that could be a place where you offset the assets you have in your 401k versus your Roth, and then own something different in that HSA. But I would still have a sizable amount. I think ours actually makes you keep $1,000 in the money market, interestingly enough,
Which it
which I wouldn't
should.
do. I wouldn't do that because I could write a check from somewhere else if I needed. I'd rather have it all invested because it's unlikely money I spend. That's okay. So that's, again, half maybe, or up to $1,000, and I don't know anything about your health, and then the rest of it invest.
Now, she also asked, and this answer is going to be in line with our belief that you should keep your financial life simple, particularly when you're younger and you're not putting away as much. When you're older, it gets more complicated. That's when you start to need advice. But she says, in what assets and how should my strategy change as I get older? And this is where a wonderful invention that I poo-poo a little bit because it is totally age-based and not emotionally based or brain-based,
Or
but
financially based, because it knows nothing about your personal
right.
situation.
But a great choice in 401ks particularly can be the target date option, which many are offering now.
And so by the way, I think a very simple add-on to that would be Paul Merriman's target date plus 20% in small value if they have that available.
Yeah. And at your age, you should be looking at a 2060 target date.
Pardon me. I'm sorry.
2060.
That's a different target date for Don and I, but that's a whole other show.
Yeah.
So,
2060 will put Don at 104.
We'll be very comfortably resting. Let's put it that way.
Wishing you all the best from the grave.
Exactly.
But really, a target date might make a whole heck of a lot of sense.
Yeah, no, again, and if you could just a little more sophistication, the target date and small value to add on, because you get so little of those asset classes.
Right.
Again, and this gets back to how much time you want to spend on things again,
and how in the weeds you want to get.
Yeah, I mean, if you want to if you're saving and it's going in a target date fund, that is fine. That's a good start. I talk to people all the time. Oh, I want to do more. Okay, then you can do more. But this is a fine place to start.
The reality is, though, most people don't do well doing more unless they have incredible discipline, which most people don't have. It's just we don't have it. We're people. Yep. We're humans. We're emotional. We're stupid. Which leads us to, for example, when we were talking about all the different retirement accounts, if you're looking at all, if all of what we said leaves your head just, this is one of the reasons why we said, well, let's see. Given the limited amount of time we have in the radio show and the podcast, why don't we make Vestory Advisors available to people to help them figure out what might be best for them? This is a perfect example. Let's say you're saying, I don't know what kind of a retirement plan I should have. I'm self-employed. I'm not I don't know. I'm just confused. Please help me. We will help, and we won't charge you anything for one meeting. If you want more, we're going to charge you. We won't push you to do anything. There's no high pressure sales pitch. You will get the help you need to make better decisions. And it's so easy to do. All you do is go to vestory.com and set up an appointment when it's convenient for you. And if that's the middle of the night, Tom will call.
Oh, you bet I would. Well, middle.
You only sleep for about 2 hours in there anyway.
Depends on what the middle of the night is, I guess.
So go to vestory.com and set up an appointment, or call our office. The number is at vestory.com, or it's 800-386-3004. If you have questions for us here on the show, the podcast, you can call those in to a different number, 855-935-TALK. That's 24 hours a day, 7 days a week.
Don will answer in the middle of the night?
Never.
Okay.
I hardly ever answer my phone.
That's a good point.
Because there's so much
stuff. Let's just put it at that.
Scams. I hate them. Or you can go to talkingrealmoney.com and type your question or speak it there too. We have that technology. We are really, really sophisticated. I'm Don. Tom's looking askance. Thanks for joining us. Tell your friends, do something nice for somebody else, be a good person. Don't rip people off. If you're a stockbroker listening, just stop it. And Tom and I are just going to hang out here until the next time, thinking about and occasionally even talking real money.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.